Today, we're going to talk about the year in review so far, all the way through the second quarter. Just a couple of housekeeping notes. If you do want to ask a question, we will be taking questions at the end. Just click on the question icon and we will get to them at the end. Also, we have, if you look at the little icon that has a paperclip on it, that you can download the copy of the slides we're presenting today, as well as our second quarter markets and factors report. John, welcome. It's been quite an interesting year so far.
Hi, William. Welcome. Yes, I was just thinking before we came on that draw a line in the sand at the end of June in 2026, and a lot has changed in the 3 weeks since the end of
Yep.
the year. So where that's relevant, we'll bring the presentation up to date. So what we're going to cover today first is just discuss the markets in brief, and look at the factors across the globe, how they performed, discuss some of the top stories, and then, of course, conclude with some summary thoughts. It was a very good half year for equities globally, especially emerging markets. Less so for the United States and developed markets, but emerging markets were up approximately 24% mid-year, which is just a fantastic return. Uh, U.S. equities and developed markets outside the United States were up about 10%, and still not a shabby first quarter performance. U.S. equities were supported by continued enthusiasm on the AI trade and semiconductor trade. A lot of really nice corporate earnings reports, and showing that the AI bump is making its way from beyond just semiconductor and the hyperscalers for a more general, more improved market breadth in Q2. Taking a little deeper dive on that, looking at second quarter and year to date, you can see the numbers that we just had. But over the past 12 months, we've had just fantastic equity returns, over 20% in U.S. international stocks, nearly 45% in emerging market stocks. And that continues a trend of, over the last 5, 10, 20 years of strong equity returns globally. Uh, no surprise, we have positive expected return in equity securities globally. It's a belief in capitalism, a belief in the fact that capitalism and corporations can create wealth and value, and that wealth and value is reflected in market valuations. So always good news for equity investors.
And just one way to read these, the red does not necessarily mean that this was negative performance, it's just that it was underperformance relative to the other sort of stocks or bonds in those categories.
Yeah, thanks for pointing that out, William. It's to show kind of the relative performance of U.S. versus international versus emerging. Uh, in terms of the bond market, year to date, it's been somewhat unremarkable. Global bonds up 1%, led by international bonds at 1.25, and U.S. bonds at 0.71. We'll get more into the bond market later in the presentation. I think what's been particularly interesting in 2026 and in 2025 is how major asset classes have ebbed and flowed in terms of their performance. So just even comparing Q1 to Q2, in Q2, the highest performing asset class was international markets, of course, led by emerging markets, showing 24%. Where in Q1, it was commodities, right? Because of the spike in oil prices as a result of the conflicts in the Middle East. Uh, Lots of dispersion of returns from highest performers to lowest performers. And then you could see that impact on commodities in Q2, where commodities was the best performing asset class in Q1. It's the worst performing asset class in Q2.
And interesting, just such a remarkable amount of change in just the space of a quarter. I mean, those two lines are almost completely different.
Yeah, and even looking at the S&P 500, which we looking prior to 2026, the black squares, you can see kind of consistently dominated um, in the upper half of this chart as a result of large cap technology stocks. And then in the first quarter of 2026, you see the S&P 500 quite a far bit down on that chart at -4%, and then a really nice bump in Q2. So there's been volatility. There's been kind of sharp reversals in the performance of asset classes. Some of that obviously tied to the conflicts in the Middle East and its impact on oil. It seems like the situation in the Middle East is changing day to day, certainly week to week and quarter to quarter. And those changes and that volatility is reflected not only in oil prices but also in equity values. Skipping a little bit or drilling down a little bit into the performance of factors, Symmetry investors know that we're a evidence-based, multi-factor investing firm, and the major factors that we consider are, of course, the market factor, value, which is buying securities that are cheap in a relative sense, size, which are securities that are smaller in market capitalization, momentum, tilting towards securities that have recently performed well, quality, uh, overweighting securities that have quality characteristics such as higher profits, lower risk, stronger balance sheet, and then low risk or minimum volatility, the low beta phenomenon and the high volatility phenomenon captured. Um, I'll point out that the minimum volatility, you see all the red below that. Minimum volatility is not necessarily or low risk, not necessarily meant to outperform the market, but to perf- but to generate better risk adjusted returns as compared to straight equity. So you see year to date, a good year for factor investors, both market and all the factors, with the exception of minimum volatility. Uh, we've got value performing well, size, momentum, just having an incredible mid year, and quality, despite getting beaten down a little bit in the second quarter. Year to date is still very strong.
And John, what are some of the factors that are driving, particularly the value factor? I think there's an interesting article in the Wall Street Journal recently about how sort of what we consider to be value has changed.
You know, we're value investors, and I know many of the people on the call are value investors, and it's been a tough place to be in the last 10 to 15 years, um, from the heydays of the mid 2000s, and a lot of that is attributed to U.S. large cap technology stocks and the Magnificent Seven and Magnificent Ten, and to a certain extent, there's been a little bit of the air out of the balloon in those stocks, and value stocks are starting to see the benefits of the AI trade or the AI explosion as well. So it's nice to see a turnaround in value recently, year to date. It does help our portfolios. Any other? What was the article's take on like
There's
new value
some
stocks?
names that you would not have thought would be value names, but
Oh, right,
yeah, yeah,
like Microsoft,
like
for
Microsoft,
example. Yeah.
yes.
So value, as you know, is you can define value many different ways, and normally it's price relative to some fundamental. So share price relative to cash flow or book value or revenue, and it's typically thought of as a reflection of the growth opportunities of a particular stock. So as Microsoft matures and their growth prospects seem to abate, they fall into the value region, which we've never seen Microsoft showing up on a list of top value stocks. The factor story outside the United States looks somewhat similar, especially with respect to momentum. And when we move outside the United States, outside developed markets, outside the United States to emerging markets, we see that a very different factor picture emerging, specifically just a very, very high returns for the second quarter and year to date, specifically in the second quarter for momentum at 65%.
In the past 12 months, almost 85%. What's been driving that, John?
And we took a look at these numbers come from momentum being proxied by the MSCI Emerging Market Momentum Index. So digging down a little bit more into that index, into that momentum phenomenon, you find that about 80% of the momentum portfolio is dominated by Korea and Taiwan, and about 70% of the portfolio is comprised of um, technology and semiconductor companies like Taiwan Semiconductor, Samsung. So it's very much been a technology driven event in emerging markets. You said that it's been a fairly lackluster treasury or fairly lackluster fixed income returns in Q1. Um, what's kept now yields are decent at this point, right? You're talking 4 or 5% in the longer end of the curve, but returns were hurt by a general rise in interest rates across the belly of the curve. You could see here in red is the curve at the end of Q2, and the yield curve in blue was the curve at the beginning of the year. So you see this general increase of somewhere around 40 or 50 basis points in the belly of the curve, which you as you would know will hurt bond returns. Not such a pronounced change at either end of the curve. Short-term rates were slightly elevated, and long-term rates the same, but not to the same degree as in the belly of the curve. New Fed watching information came out yesterday. The new Fed chair, Kevin Warsh, decided to keep the Fed funds rate constant until the next meeting, and that is consistent with what he did in Q2. He's been under a lot of pressure
Yeah.
because of rising inflation to perhaps consider a rate increase, but he held off, which I suppose is good news for markets as the markets are up today. The other impact on fixed income has to do with credit risk and spreads. Um, From the line I draw your attention to is the line at the top, which is the kind of spotted magenta line. Um, it starts as a spread above treasuries, which indicates high yield. It starts at a spread above treasuries at about 300 basis points and ends the second quarter at a similar spread. There was a little spike in mid-March with the market downturn and some worries about GDP, but spreads have basically stayed the same over the quarter, rising in Q1, falling again in Q2. So moving from kind of investment focus factors, GDP and interest rates and spreads, we'll move to kind of more of a macroeconomic look at at the first half of the year. The year or the mid-year ended with unemployment at 4.2%. What was interesting about that number was the labor force participation continuing to fall. Labor force participation is people who are in the workforce or actively seeking work. And that has been a concern of the Fed for a while, is a decreasing labor participation rate. But you could see that there were jobs added in June, 57,000 jobs. And this slower job growth was at this time easing concerns about inflation. Um, I think that was somewhat outweighed since the close of the second quarter by the spike in oil prices and a renewed worry about inflation. This shows how quickly things
Things can
change.
change. Yeah.
In terms of GDP growth, second quarter GDP increased at an annual rate of about 2%, which real GDP growth of any quantity is good news. 2% is not thought to be an inflation producing growth rate. That would be more 3% or so, but it's clearly positive growth. A lot of that growth being driven by um, AI type spending, um, capital expenditure for AI infrastructure. Imports continue to track from GDP. So solid economic growth, along with slightly elevated inflation. June CPI was up 3.5%, May 4.2%. That's annualized.
Yeah.
Above the Fed's long-term target of 2%. I don't know that I've heard the new Fed chair Kevin Warsh articulate the 2% target. That was more of a Jerome Powell
Mm-hmm.
idea. Um, but if we take that 2% target um, as still holding, we're running quite a bit above that, which is why the thought was today perhaps we would have seen a rate increase.
Well, he's sort of, you know, he has some pressures on him.
Yeah, he might be more sensitive to the whims of the executive than the previous chair, but
Yes.
that will remain to be seen. Part of the story with inflation and the market is certainly oil
Mhm.
and the issues in the Middle East and the Strait. And depending on what time of the day you look or what day you look, you could have a very different picture about the prospects of oil prices.
Right. This was done for just for the second quarter, and since then they've obviously oil prices have gone up significantly. And one of the things about oil is, there is no agreement about what price you start to have a significant impact on the economy, but it is, some would say $100 a barrel, some would say 135. But the key thing is, how long does it stay at that rate? For every sort of $10 increase in oil prices, we have an estimated impact on the economy of about 0.1%.
Wow. Yeah. You could see here from this chart that oil prices had this steep rise in mid or end of first quarter, beginning of second quarter, rising to above $100 a barrel, and closed the quarter at $70. But I looked this morning at, I think the price was at 85 or
Somewhere around
87.
there, yeah.
And there was some optimistic chatter today about producers in the North Sea increasing output. At the same time, there was some negative news about hostilities in the Strait. So again, depending on what time of the day you look or who you're listening to, oil and the prospect of future energy prices weigh heavily on the market and are highly volatile. Looking at consumer confidence and sentiment, um, sentiment was modestly down. It really weakened at the beginning of the first half of the year, and then kicked up a little bit. I think that's probably driven a lot by oil prices and what the prices that people are seeing in the at the pump. VIX, which is a market-based indicator of volatility. It's the implied volatility in S&P 500 options for the next month. Typically, people view this as a gauge of future volatility. Sometimes it's called the fear index. Right now, or at the end of the second quarter, it was just around 17%, which historically is about normal. I think it has again been on a wild ride with what's going on in the Middle East. Has really been driving it. Couple of interesting things that happened, I think, in a finance perspective in the first half of the year. One was the SpaceX IPO, SpaceX ticker SPCX, and the discussion of the IPO between politicians and Elon Musk. It really occupied a lot of print space and conversation in the first half of the year. So, what happened? Well, it was the largest initial public offering ever. And the first trading date was June 12th of 2026, where only 5% of the outstanding shares were offered, and they were offered at $135 per share uh, in the primary market, which gave gross proceeds of over $80 billion. But more importantly, it valued SpaceX at nearly $2 trillion.
Which was the equivalent of the next 14 largest aerospace companies in the world.
Wow. So it made Elon Musk a trillionaire.
He is no longer a trillionaire since the stock price has fallen. He is only just a multi billionaire.
Yeah, I saw where he corrected politician the other day, and when she called him a billionaire, he said, "No, no, that's a billionaire," which I thought was very funny. Um, but the as you could see from the Bloomberg chart here, which starts at the IPO price of 135 all the way to the left, got a nice pop on the first few days of trading in the secondary market, up nearly 20%. And since that point has fallen to quite drastically to less than 20%, 20% less than the IPO price.
Right. And typically, just one thing to remember about IPOs is that when you look at them, they can be very exciting. There's a lot of hype. But historically, they have not been great performers over the sort of the subsequent 12 months. I mean, if we look at the last 10 or 12 IPOs, they averaged about a negative 28% return a year after going public.
Yeah, there's actually a large body of academic literature on IPO pricing, and the typical pattern over a long period of time. It's done by Jay Ritter at the University of Florida. Uh, you get this pop on the first day, followed by a reversal, followed by long-term underperformance, long-term being a year or two out. And there's a lot of forces at work in IPO. There's price support from the lead investment bank. There's lockup periods that expire, and then people want to cash in. Uh, there might be overenthusiasm or overreaction at the beginning that kind of gets reversed. So our some of our investment partners choose not to participate in adding IPOs or recently IPO'd stocks to their portfolio, preferring to wait a year before they're added. Another interesting story that came across the wire in the first half of the year was the short squeeze on Avis. Avis, the car rental company. Um, their ticker is CAR. And here you could see a price chart from Bloomberg over the course of the first half of the year that shows the precipitous rise in Avis's price from about $100 to over $700 in a short period of time, followed by a very precipitous fall. And this price movement is indicative of what is known as a short squeeze. And so, just a short recap of what happened is Avis was a heavily shorted stock coming into March of 2026. About 50% of the shares were shorted, meaning people, namely hedge funds, investors, were betting on the stock price falling because that's when short sellers would benefit. Uh, Avis has a deep pocket hedge fund as its primary owner. It's called Pentwater Capital, and they own about 70% of shares, and they were increasing their position, and they had ownership of most of the outstanding shares, which made the stock difficult to short, and it caused the shorts this price increase caused by them increasing their position was causing short sellers to want to close their position because they were getting squeezed. Squeeze just meaning they were experiencing losses as the stock price rose. And the mechanics of short selling is that in order to close out your position, you need to buy shares in the open market. Well, those shares weren't ready available. As they were bidding up the price of those shares to close their position, it just made the situation worse for the remaining short sellers. And that's the nature of the squeeze. Eventually, when the squeeze is alleviated, the price will pop and it will go back down to its pre-squeeze levels, which is what we saw. Avis sank over 70% in only 2 days.
John, as we see more investment vehicles beyond hedge funds, adopt models or investment approaches where they're using both long and short selling, do you anticipate there being more short squeezes? I mean, now there are mutual funds that are doing, long short strategies, and so there's a lot more players that aren't there.
Yeah, I don't know that I could say there'll be more. I would more speak to it from a portfolio manager standpoint was what can you do as someone who's taking short positions to avoid getting squeezed? Probably the couple of things I would point out. One is you want to have a diversified short book. You don't, if you're holding one or two shorts or a few shorts, then obviously you could get hit, and your short book could really suffer quite a loss. But if you're holding hundreds of securities short, where you put position limits on those shorts, that would be in the position of managing a short portfolio rather than someone who's trying to take a bet on the downfall of a particular company. That's one way to kind of manage the short squeeze risk. Another is to avoid stocks that are difficult to short. In that case, that would be Avis, right? It was getting very expensive to short. If you're managing a short book for a long short portfolio, staying away from those shares would be a good idea. And then also to have some sort of risk limits on when you start to experience losses in a particular position, that when you reach a certain level that you close the position. So I think, back to your original question, which is a good question. If I had to think about it, I would say, yeah, the more people are shorting, and short interest rise, that the probability that any one stock could end up in a short squeeze is probably higher. Although I would say short squeezes are um, a fairly infrequent event.
Right. There's generally like one or two a year.
Yeah, that we can talk about that are interesting.
Yeah.
Avis before that, GameStop, and
Mhm.
they'll pop up from time to time. It does bring up this concept in finance called the limits of arbitrage. Uh, Even though um, sophisticated hedge fund investors were convinced that Avis was overvalued and that they wanted to take short positions to benefit from that overvaluation, um, the market did not allow them to arbitrage that position. The short squeeze got in their way, which is kind of interesting, kind of an interesting outcome, in that you could be very sure of your position, um, and you could think that the market's going to act rationally and that the price of
Yeah.
Avis is going to fall when you take your short, your profit, and then the price skyrockets because of the limits of arbitrage. Very interesting. So, in summary, it was a good first half of the year. I mean, take that first half of the year anytime. Strong, strong equity performance. Um, So fixed income performance, inflation that seems to be tame, a job market that is cooling but still growing, a GDP growth rate that's reasonable. I think the issues that we face are, the uncertainty of the conflict in the Middle East. It appears that tariffs have reared their ugly head again. We thought that the talk of tariffs had kind of subsided in the first half of the year, but since June 30th, there's been renewed discussion um, at the executive level about reinstituting tariffs across our trading partners, which everyone agrees is not good for economic growth and probably will not be good for the market. Uh, the ups and downs of oil prices based on world events, the choppiness and unpredictability of asset class returns kind of leads us back to our our story, which is we think you're best served by being broadly diversified in many ways across geographies, across investment vehicles, across asset classes, across factors. Try to avoid concentrated positions in all their forms. Um, be trustful of the market and not think you can outsmart it. And if you believe in those things and capitalism creates wealth, then you have a portfolio that allows you to share in that wealth. We feel that's the best path to long-term wealth creation for you and for your clients.
Now, if anybody has any questions, you can put them in the chat panel, and we'll get to them. But John, question for you: this is an election year, and I think it might be helpful, sort of giving Symmetry's perspective on election years and markets and investments.
Yeah, there's been a lot. Every election year, there's a chart that shows what happens if the Democrats win, what's happened if the Republicans win, what happens if there's a flip from Democrat to Republican, Republican, Democrat, and people try real hard to find patterns in those things. Um, I'm not too sure. I'm not very confident in any of those findings. One is the number of observations is very, very small. We need, with statistical analysis comes a concept called power, and the power to make statistical inferences rests on the number of observations. So if we've got, I don't know, 25 observations for the last 100 years, that's not a lot of observations to say anything. Um, I would say, a couple of things I think the market is clear about is, uh, less regulation, um, less taxes where possible, pro business, um, are considered positive things for the economy, positive things for productivity. And I think a candidate, uh, whatever their stripe, who espouses pro growth policies, good economic policies, um, the market will recognize that, whoever that person may be.
By a number of indicators, the markets are at, um, all-time highs, or, close to all-time highs. Is this something that you worry about?
You know, there, there's some research done by Robert Schiller from Yale about the what's known as the PE ratio, or the inflation adjusted PE ratio. It's called Schiller's PE. And Schiller shows that when the PE ratio is elevated, as it is now, that returns in the subsequent 10 years tend to be muted. Not negative, but just muted. And when the Schiller PE is low, meaning that stocks are cheap, that returns in the subsequent 10 years tend to be very high. So I wouldn't advocate timing markets based on the Schiller PE. But based on that, I would say that we should have muted expectations for returns in the next 10 years based on that one data point. Now, that assumes everything's constant. I think the big unknown here is AI and the impact on productivity. We haven't had, you could say maybe the internet revolution, maybe the industrial revolution, combustion engine were all kind of similarly important, significant events that might blow that thesis away. But I think it's probably not ever a bad thing when dealing with your clients as an advisor is to temper expectations about future equity returns. And I'd say that's kind of where we are now, where I am now.
Mhm. And I find it interesting with, all the speculation that's going on about AI and AI stocks, and even though some of the air has gone out of them in recent weeks, to think about like the last 30 years. And, the number one stock in the last 30 years was not a high tech company. It was not a technology company. It was not a biotech company. It was Monster Energy drinks. And, and just the idea that, sometimes investing in the future doesn't necessarily mean invest in future oriented companies.
Right. Yeah, I remember decades ago or a decade ago, a Symmetry presentation used to use the example of spam versus Motorola. So at the advent of telecommunications, mobile phones, if you knew what you knew today, would you rather invest in Motorola or spam? And the answer, of course, was spam outperformed Motorola in the subsequent 10 or 15 years following the advent of mobile phones, which nobody would guess, right? So again, I think that speaks to diversifying, right? Companies of all, the hope would be that companies, industries, sectors of all types will benefit from improvements in technology and lead to productivity gains. How that's going to play out in an individual stock or an individual sector or even region is hard to say.
And we've talked about some of the things that are kind of flashing warning signs or things to be potentially, concerned about: price of energy, possible inflation, of course, geopolitical uncertainty. Obviously at Symmetry, we don't predict, we don't prognosticate, but what are some things that investors might be sort of should be optimistic about or could be optimistic about for the rest of the year?
I would like to think that the troubles in the Middle East can be resolved and that the price of oil could be stabilized. You know, uh, I don't know about the rationality of the actors on both sides of the negotiation, but it would seem in the best interest of the world and the best interest of both sides in the negotiation to reach some sort of an agreement to move forward. So I would hope that those actors would be rational, and that we could move past the current instability caused by the turmoil. Um, I'm an I think we're long only investors. We're long term strategic. We believe in capitalism. We're optimistic. So I'm always optimistic about the future of certainly our country, but even of the world, to continue to innovate, increase productivity, and generate wealth.
Well, thank you so much, John, for your time. Thank you, everybody, for joining us, and we will see you in 6 months for a wrap up of 2026.
Thank
Thanks
you all.
again.